Everybody, welcome. We have our longtime friend, Gary Mishuris here from Silver Ring Value Partners.
Hello. Thank you for having me.
And we have Mo.
How are you guys?
So first question, Gary, let's get right into it. Me, Mikey, and Mo, who do you like the most?
Pass. I mean, you're going to hear that a lot. I feel like, we're going to have the which stock do you like the most?
No. I'm not doing which stock we're talking the most.
Told me before the show was me, so let's go on.
Okay.
So Gary is a value investor. I met him through LinkedIn.
Mm-hmm.
You slid into my DMs. This is quite true.
I think he meant slithered.
Yes.
But yes.
So if you remember, you wrote me a message saying, Paul, I see your comments. I would like to ask you some questions. And I wrote back, wait, is this a generic email you're saying to everybody? You're like, no.
No, it's my virtual assistant from the Philippines.
That's what I thought it was. So I was like, what are you doing? You're like, no. I see you post on value investing, and I actually
you're
have
like the only one, though. That's the thing. It's like it's easy. You're the one guy who is posting
consistently.
And so
I was in Mexico at the time, and so we scheduled a call.
Yeah.
And we spoke, and then you said, so I teach people value investing. I have them read security analysis. By the way, you want to hear a tragic of all tragedy?
No.
Oh.
Gary, you don't want to know this.
I own a security analysis signed by Warren Buffett, right?
Yeah.
It might have been lost in my move.
No.
Yeah, so
I remember we talked about it.
I know.
It's not as valuable as the one I sent you signed by me, so you're still fine.
Which is up in my office, by the way.
All right, so tragedy averted.
So anyways, Gary, we spoke, and I said, I'll take your course. And we did security analysis, the most mind-numbing book of all time. But you've read it how many times? 3?
3, and then I read probably another 2 times piecemeal as I teach the course to various people in my seminar and school. And so
do you reference back to that book all the time?
I do. I'm such a dork. Obviously, so security analysis is the professional version, like Intelligent Investor is for lay people. So I went to the beach like a year or 2 ago, and I brought Intelligent Investor with me. I know it's like I'm sure, 100% sure I was the only one.
That's your leisurely reading.
And I just read it, and it was like, a lot of this resonates because they were talking about like the decline after the go-go years and like the early 70s,
Nifty 50.
Yeah, and the collapse. And I'm like, the path, it's the same path every time.
Yeah. Every single time.
Times every time.
Well, again, it's different enough because it can't be the same,
different
right?
Players.
Like if it was the same, like Jim Simmons or some guy would be like arbitraging the other way, right? But the point is the psychological development of these things, the extreme highs and extreme lows are the same, right?
Different players, same game.
Yeah, and I started in the telecom bubble, right? That's kind of how I grew up as an investor over 20 years ago, and I'm like, this resonates. So anyway, so if you don't count my beach reading, probably only about 5 times.
Okay.
Well, the funny part is, I love hearing young kids now say, no, the .com was different. This is EV. This is crypto. This is a totally different. I'm like, oh, it's totally different.
Right. It was different that time too.
It was different. And that's why I tell them, I go, guys, I get it. You have to experience it like I had to experience it. Back then, it was, no, it's different. It's the internet age. And there was no doubt in any of our minds that internet was the future. Doesn't mean you pay whatever price. Just like EV is probably the future for vehicles.
Right.
I mean, Ferrari just announced that in this decade, they're probably going to have 100% EV. Of course, right? But the whole point is that doesn't mean that. Anyhow, so Gary and I did the class with Gary. So Gary, when people ask me, Paul, should I read security analysis? I say don't. And the reason being is I think a big reason why you did it, correct me if I'm wrong, is to weed people out. See who is serious about learning about investing. Is that correct?
I wouldn't put it that way. I actually think that reading security analysis you shouldn't do. Like I agree with that. You should not.
Okay,
but
good.
Studying it, which is like Intelligent Investor is a book you read like on the beach.
Right.
I know, like you're not going to.
Jerry,
But
no one's reading Intelligent Investor on the beach except for you,
for me.
maybe me.
Not
even
even
then,
you. Not
I don't
even
think I would do that.
Mexico Riviera or something like that. But I think you can't read security analysis because it's not, and that's what sometimes I get students, so I have interns and they have like 3 or 4 interns at a time, too many probably. And we start with security analysis, and sometimes they say, I've read it. I've read security analysis. I said, but you haven't read it with me. And that's not like a statement of arrogance. It's like, they've read it, they remember stuff. And if you ask the average value investor who remembers reading value and investing stuff or security analysis, what do they remember? They're going to say nets, right? That's going to be like the main thing they remember.
And can you explain everybody what nets is?
Nets, right? So if you have enough working capital that after you haircut it for some liquidation discount, you subtract all liabilities. If the stock is less than that, it's trading below liquidation
the market cap
value. Yeah. So it's kind of what used to work in the 20s, 30s, maybe 30s, 40s, whatever, and then they dried up, right? And people say, well, it's not applicable. It's like net's a gun. What's the point of reading it? And that nets is like this big a portion of the book of like that's that thick, right? And I think that there's a lot of insight. For instance, like Graham is always pigeonholed as like a numbers guy, purely quantitative, and he is certainly more quantitative than Phil Fisher or whoever. But he actually focuses on quality more than people think. And it's hidden a little bit that you have to study it. You can't just skim it, right? We just like you get a book this thick, you're gonna mostly skim it. Most people, right? You know. So actually rereading it, and his sections like on growth investing, I think are great. Like he doesn't say growth investing sucks or it can't be done. He says these are the challenges. Now, if you can overcome them,
they're
terrific.
Great.
But these are the pitfalls, or these are the things that have gone wrong with people trying this approach. And this is what you should be wary of if you try to do it.
Well, it's funny you mentioned that because you know, Mo and I, as part of our value investing, the most common comment we get is, "You guys don't understand growth." And I'm like, no. We just don't overpay for growth. There's we have our stock analyzer tool. It's a model to build for the very first line, revenue growth assumptions.
Yep. Right.
Very first line. And I like the Philip Fisher. Like when you read Common Stocks and Uncommon Profits.
Yeah.
Go ahead.
That was a book that I just recommended to somebody to read today.
Sure.
Is that book?
It's a great book because it's, hey, listen, I love growth. I love to look at like, you know, one of the stocks that I'm looking at, I was talking to him about today, is Foot Locker. Now, Foot Locker, it's not a growing company in the sense of you don't see major growth level. And it's got a lot of retail, so it's got its headwinds. But I told him, I said, you know, one of the things I like about it is they've decreased the number of stores and footprint they've had by 15%, and their revenue is up. Okay, I like same store sales going up. There's a lot of aspects to it that I sit there and say there's a qualitative part to it that I like, but it's also, for me, driven by the quantitative. So I think that's the thing about Ben Graham that might be it's like me. Quantitative drives my, do I go further? Would you describe that for yourself too? Or, because you're not going to waste your time looking for quality first and then look for the quantitative. Aren't you going to weed out with the quantitative, or is that different for you?
I think 80% of the time that's right. There are special situations or there are setups where the numbers don't accurately reflect the economics, where the quality, I mean, an example would be where a company is running growth investments through its P&L. So maybe subscriber acquisition costs, right? And maybe it's growing rapidly and it looks like it's losing money, but a lot of that cost is really to grow. Of course. If you were to look at steady state, if they were to try to keep customers flat, they would be spitting off a lot of cash. So sometimes if you purely screen and you just like blindly download Bloomberg or FactSet or whatever capital IQ data, you'll be fooled with that. So, but I would say the reason like Benjamin Graham is the place I start is it's the most teachable approach. Like if you study it, you will be proficient at it. You don't have to, you probably won't be great at it, but you'll be proficient, and you'll also make a decent return with low risk. Like that is almost a guarantee. As long as then the sticking part, it's hard. It's kind of like in poker, right? If you play poker, having starting hand requirements, right? If you play very tightly in most, but the highest stakes games, you will show a profit. But if you want to go and be this crazy aggressive player who bluffs everyone, is very good at reading the people, whatnot, you will make more than the more straightforward type player. It requires so much skill.
Right.
And what you also don't see, you see the guy with the stack of chips playing that style. You don't see the 10 guys who busted out trying to pull what that guy did.
Of course.
And that's a selection bias that I think the Phil Fisher style produces the highest returns.
Right.
But it also produces the highest losses too, and or the highest bad track records, percentages. So it's the degrees of difficulty is higher, and I can teach almost anyone to be a proficient Graham investor over a few years. And then there's degrees of skill. But I think, I don't know how to be a good Fisher investment because, and we can get into it, but there's so many nuances that people don't understand. Like even portfolio construction, like you're drawing from a power law distribution, meaning a few winners will carry the whole return, the Fisher kind of construct, right? Because, so meaning, what does that mean? So two things. One is you learn a lot slower because think of the feedback loop. Like if you get something wrong, it's in a high batting average style, that's negative feedback. Let's say if you expect to be right 60% in a Graham style, then you get 3-4 things wrong. You're like, that's a counter indicator. I need to rethink, retune my process. But if you're only supposed to get 20% or 30% of things right, and you have high slugging percentages, right? Then getting a bunch of things wrong is not necessarily, is it a signal that you're bad or a signal that you just haven't gotten the big winner? That's number two is, how do you actually hold the big winner? Like I know a number of people who gotten Amazon right from the early days, but they haven't outperformed overall. Like how is that possible? And it was their top position. Well, they keep trimming it to 5%, to 10%. If you really let your winners run, what's going to happen is you're going to have 1 or 2 or maybe 3 stocks compose ginormous portion of your portfolio, most of it, right? And by year 15. And so you have to keep being right. And I don't want to diss anyone, but recently Carvana is a good example. There were some very thoughtful investors I know who I think are really smart. They might be proven right, maybe not, but there was a fund I'm thinking of that essentially became the Carvana fund. Now, the person was letting the winner run. They believed in the model. They still believe in the model. They might not be wrong, but now essentially someone joining that partnership essentially is like buying a portfolio that is 70% Carvana and 30% someone else.
Right.
But if you start trimming it back to 15% or whatever the at cost thing was, then you never catch the power law distribution. And I grew up poor and I just don't like losing money. So
I grew up rich and I hate losing money.
I think that's I think that's what unites everybody. Rich,
poor, value investors.
No, but I think like, if you like when you like. I grew up with a single mother and started on welfare.
Immigrants.
She got a job, right? And like I just remember like how hard it was to get the 25 cents for the juice kind of thing, like right? And so I just have a visceral distaste for going back to square one kind of thing, even if on the other side of that is a huge win. And so I kind of purposefully, like I always tell my students, like humility is not the opposite of confidence investing. Like you can be humble and confident.
Yeah.
And I just want to be humble, maybe just realistic that I'm just not going to be that great at forecasting 20-year cash flow streams and really extreme outcomes. Now, I think that there are a small number of people who are going to be great. But I think for every person who is going to be in that set, there's probably 10 to 100 people who think they're going to be great.
Can I recap what you're saying for everybody watching? Yeah. So what I understand Gary's saying is, on the extreme levels of these massive growth companies that you have to believe in, that the numbers don't say it today, but you could be right. He cannot reasonably estimate how much they're going to make in 20 years. There are a few people who might be able to, but there are 10, 20, 30 times more who will not be able to and will probably go and ruin because of it.
Yeah. Or if they don't go to ruin, they're going to have very mediocre records because they'll get shaken out. Right?
I know.
Like they're gonna have these
Kathy
things.
Wood.
Oh well, I'm not. Warren Buffett says criticized by group, but praise individually. So I'm gonna stick to that.
Well, I'll tell you something about Warren Buffett. I like him, but I think he's kind of a pansy when it comes to I like the Munger style. Munger just says it how it is. You know what I mean? Buffett's more like, let me make everybody happy, or maybe let me make happy the person who's most likely to be upset with me. And it said that in Snowball, and I love Warren Buffett and his ideas, but I can't stand it when he compliments, because what was the guy's name? Sokol?
Oh, I know. I remember we were talking about Sokol. Yeah.
He was talking about
the
how
guy who bought Lubrizol.
Yeah, Lubrizol, based in Cleveland. So he was praising this guy, and then all of a sudden it was, he's fired, he's screwed up, he's this. I'm like, so to me, that's this dichotomy of, he's awesome, he's the best thing ever, and then, oh my God, he's so bad, I've got to fire him. It's like, if he is awesome, best thing ever, it's like, listen, I sat down with him, and I said, hey, what happened here? He explained it. I said, you can't do that, but you're awesome. I'm going to keep... But it went from, he's the best thing ever, to, you're fired, you're out of here.
Well, I forget which annual meeting it was, but Charlie and Warren talked about that. So Warren turns to Charlie and says, so Charlie, do you think it's ever wise to criticize anyone? And Charlie turns back and says, Warren, probably not, but I can't help it.
Yeah, exactly right. So, Going back to your forecasting out 20 years and whatnot, I think this is something that a lot of people miss. They think that we just are not good at it or whatever. And I think
nobody's good at it.
You said the word realistic. You need to be realistic about it. And that is the perfect summation of
I think you look at Apple and Warren Buffett's investment in Apple recently, and we like Apple too, but ironically, probably makes sense at much lower prices than Warren Buffett. Why? He's got the capital, and we'll get into that shortly, but it's probably much easier to determine what Apple's going to make over the next 20 years than what Carvana is going to make over the next 20 years.
Sure.
What Rivion's going to make over the next 20 years. And I think that's the point that people miss, is that, yes, we pick the boring big companies. They don't have much growth potential. But our goal as value investors is, and we talked about this in our first call. I said to Gary, I like large cap companies. I'm willing to make less return because I want the companies that aren't going to zero. I'm invested in Gary's fund. He owns stocks that he say, I can't even tell you what stock this is because it's a $20 million market cap. And if you know about it and start back, what's it called? what's the term when you're like you're following you or whatever?
Oh, yeah. Front running
you, then it's going to affect your returns. So, I look at that saying,
I don't have that many of those, but
No, he does.
But you do.
I have small.
You do invest in them.
Well, so my theory on that is this, right? So like you have a universe of 10,000 companies you can invest in, whatever it is. A bunch don't meet your qualitative criteria, or you should have some qualitative criteria for most styles, right? So maybe that universe is, maybe it's 100 if you're really high quality, maybe it's a couple of thousand if you're a lot looser, but depending on, should have some sweet spot. Okay, so large caps are higher quality on average than small caps, right? But there's like 5-to-1 ratio of small caps to large caps. Right. So if you're truly going where the opportunity is,
you gotta go small.
You should have both. No, you should over time have both investments types. But just if you're not being biased by size, if you're saying I'm gonna pay zero attention to size and I'm just gonna pretend for equal quality, valuation, growth, whatever your other parameters are, I'm gonna ignore market cap other than liquidity. Let's say you have a lot of money, you can't invest in 20 million, but liquidity aside, you should have more small caps, unless you have such a, you really are saying, I just want the nifty 50 kind of redux kind of thing. You want, the apples, the FANG, whatever it is. Right. So the other thing is the efficiency of the market is higher in that bucket.
Of course.
So you can be like someone, and it's easy. I don't know, it's easy. It's much easier to find 10-year records than it is 20 and 30-year records. And like John Neff is probably the best public example I know of a large cap manager, consistent approach.
14-15% did he get?
Well, I forget the number, high? But it was 300 bips or 3% per year of excess return. And that's during a less efficient period in the market. This was, I think he finished in the early 90s or something like that. I forget exactly when he stopped investing. And he was at Wellington, the Windsor Fund. So the team I was part of at my prior firm before I started Silvering, we had a large cap strategy, and we had not Warren Buffett's, but we had a reasonable team, I thought, with a good process and plenty of resources and so forth. In the large cap strategy, we beat the market by like about 2.5% over like 10, 11 years during which I was part of that team. I don't know, the numbers are different now. I don't know what they are. And that's gross. That's before fees, right? So you figure you put in some kind of fee. Let's say that strategy charges 50 basis points. So now you're sub 2%. That is really probably close to what a really good approach in the mega cap, large cap space should give you. Again, I'm not going to criticize by name, but there's a very well-known value investor in the value investing community who's known for international investing large cap, and he gives a lot of talks. Again, maybe off the record I'll tell you, but not on camera. And I got his letter recently. It's like 20+ year CAGR. His excess return like 1%, because he buys these very global consumer companies, holds them forever, and like I always wondered are the markets that inefficient? Like you can buy a giant, well-followed, well-known company, hold it for 20 years, and it keeps being mispriced every year. Like, how does capitalism work then? Like, if it's like these super-duper, well-known, well-followed companies mispriced, because it's not supposed to work that way. The secondary markets aren't there for you and me to make an extra dollar. They're there to raise capital efficiently for the companies and then provide efficient liquidity, reasonably efficient, meaning like within the ballpark of fair value, you should exit. If we didn't have that, then you would have higher cost of capital, right? So company wants to start a plant, build and make widgets, and it's raising money. The people giving it money will demand more if they don't have liquidity to sell at roughly a fair price. So you can't, I just don't think the capital markets will function very well if you have very large known companies that are perpetually mispriced.
So, and I think my take on it is, if I'm looking for larger companies, and I can wait for opportunities in which the entire market is mispriced.
Yep.
And hopefully get in those companies. Now, the theory is then, like you said, well, what about 5 years later? Well, what about when those companies are fairly priced? What are you doing to add to your? How are you adding to your portfolios? And that's the issue that I think that Gary brings up. That is a valid concern from that standpoint. And yeah, so I look at, so Gary likes to focus, like, what's your average market cap, do you think, on your holdings? A few hundred million? Or is it higher?
My range is right now about 50 million to 40 billion, and I would say the median, I only have 8-9 investments. The median right now is probably about $1 billion.
Okay.
So it's heavily skewed to the lower side.
Very much so.
For sure.
Yep.
But again, I don't want to create the impression. I'm not trying to traffic in the the pink sheets or something like that. And there are also differences where a small company can have dominant position or very strong position in a niche, right?
Of course.
And it just happens that the niche is small. So the number one player in that niche would just naturally peak out at the small market cap. That's very different than having the number 6 player that's behind a bunch of large competitors, right? So there's different industries where being small is okay versus there are other industries.
Can you give an example?
Yeah, I can give you. So I own OI Glass, and not a recommendation, you should do your own work, and I might sell it tomorrow or not. I've owned it for a long time. They make glass bottles and glass jars, right? It's a scale business. It's an oligopoly. They're number 1 in the U.S., close number 2. There's 3 to 4 players in Europe, and they're number 1 number of Latin American markets, right? Barriers to entry are high and so forth. It's not like there's some mega cap player that's 10x their size that you could invest in. Now, there are other packaging companies that are bigger, like Ball is an example.
Oh, we just looked at Ball the other day.
So Ball is a very high quality, higher growth company, but OI Glass is, much more, in my view, undervalued. Now, again, my view could be wrong, whatever. But the point is that it's just not that I'm not starting with the premise I want a small cap company because I want to have my portfolio look cool and have companies no one has ever heard of. It's kind of where my process led to. And if OI had been a $20 billion market cap, it would be fine by me as well. That doesn't really. Now, I'll be a little more skeptical of myself. I'm like,
what am I missing here?
It's like the old joke about the economist, the
$100 bill.
$100. We used to talk about $5 bill. Now I know what circles I'm running into. I'm gonna ask you later. What would it take for you to pick it up? Like, what's the minimum?
I picked up quarters before.
Quarter. Okay, so nickels and dimes.
I just don't see them. There you go.
I don't see them. They're filtered.
Blind to them.
Your AR glasses just filter out the quarters and nickels. Yeah, but you do.
By the way, that joke is an economist would walk down the street, see a $100 bill, wouldn't pick it up, saying if that really was a $100 bill, somebody had picked it up already. And
because if the market were efficient, it's like an efficiency market efficiency joke, right?
Yeah.
And I think that's very important. Like, you want to question yourself. Like, the best, you should always understand the opposite point of view and what's the mispricing, right? Like, we can certainly get into it, but there's not that many sources of mispricings, right? Now, there's informational. Most of those nowadays lead to jail. There's analytical. And that's what a lot of the Phil Fisher kind of followers, try for. They try to have a different construct of the business, different, they think that in the reinvestment economics and the runway for that are much better, much different, right? And that's the whole argument with Carvana. Is Carvana terrible? Is it great? That's the debate there. I don't have an opinion. It's in the too tough category for me. And then there's behavioral, right? And I'm a big proponent of that, because if you have the right temperament, and I do, and it doesn't sound very humble. I do, and
you do.
Most people don't.
No, you do.
But most people don't, right? Just reality is, I used to work for a guy who was a senior value PM with a bigger shop, and every time a stock declined, he wanted to sell.
Yep.
He would sometimes be able to override his impulses, but that was his, whenever something goes down, my first inclination is like, all right, let's go.
Let's buy more.
And that's not because the whole Buffett of hamburgers on sale, you should always buy more. He does not say you should be excited to buy more. The difference here is, it's with a hamburger on sale, what was on sale hasn't changed. It was a hamburger and isn't a hamburger. The value of a company is both uncertain, meaning it's a range, and it's dynamic. It changes. Like, imagine you have a business that owns 10 gold mines, right? They have, in there, maybe there's some probability, like there's a gold nugget worth $100 in each mine or whatever, right? So you can estimate the value, and there's a range of probabilities. But once you actually dig for gold,
there's one probability. There's one.
Yeah. The collapse. But so you should update that, right? Then certain changes. But then a meteor strikes all the mines and destroys them, right?
So let me interrupt you real quick. A very common question I get in our community is, Paul, what happens to you when a stock goes down? I go, if it goes down materially, 20, 30%, I sit there and say, okay, time to reevaluate. Because like Gary said, maybe something has occurred that I didn't factor in before, or I factored it in, but in my head, I thought to myself, so look at Carnival Cruise Line, for example. When I first evaluated Carnival Cruise Line, I think you and I talked about it. You said to me, Paul, what do you think it's worth? I said, I don't know, 50, 60. You said, that's not about right. But my assumption was based on X debt and X shares outstanding, which since then they have surpassed.
Yep.
So people are saying, Paul, do you think you're wrong on Carnival? I said, listen, Carnival at $10. Am I wrong in my initial 50 to 60? Yeah, probably. But do I still think it has upside potential? Yes. even with the extra dilution, extra debt. But my original thesis has changed, but the stock has fallen enough where I still think there's upside potential in that. So I hold my Carnival Cruise Line.
It's a very, so there's this debate in the value community about what is a value trap. Because what you described is also almost a quintessential value trap, right? It's always below your value. The price declines, but the value declines, but the price declines, right? And there's always a gap, and you can never sell. I remember when I was a young analyst at Fidelity, Dow Chemical had this agro-sciences business, and everyone was saying, "Why don't you sell? It has nothing to do with the rest of the business, which is like commodity chemicals like ethylene, propylene, and so forth." And they say, "Well, we think it's worth more, and the market will give us." And then every year they still say that, but now what they think it's worth has come down. And it's like they got value trapped in their own business, right? In the private markets. But I remember I asked Jean Marie Villard once about the value traps, and he said there's no such thing. He said there's no such thing. It's just when you're wrong.
Yeah.
Mm-hmm. But I disagree, because I think what's happening is, I'm a big fan of behavioral kind of analysis, right? And so we anchor on the value.
Yep.
And I think so. I have this thesis tracker that I write about in my letters, and one of the things I do is I grade each quarter versus my long-term expectations. Not like the stupid game of whisper numbers, but and estimates and did they beat or not. But if I expect a certain level of margins, a certain level of organic sales growth, a certain return on capital, did they come in roughly in line? Did they come in much better, much worse, a little bit better? And I have 5 colors, right? And I have certain rules that are triggered by that. Like if there's 3 in a row that they have orange, which means slightly worse, I reevaluate and I automatically don't add, freeze that from adding. Because, there's an old joke, at Fidelity, there was an old joke about a PM who lost half the fund in a 5% position, right? How does that happen? You keep doubling down and it goes down and goes down, right? Because this is your ego trying to prove to yourself that you weren't wrong, right? And the other part is thesis creep, right? Well, I was wrong initially, it's worth less, but it's so cheap now that I'm still, and so it's hard because, there was a guy I met, I think he was an old PM Putnam, who had this rule. If something went down 15%, he would automatically sell, wait 31 days, and then decide if he wants to go back in. And he ran a tax managed strategy, so he could get tax loss, and he would get rid of all these anchoring endowment effects, which endowment effect is, I like this because I own it more than that, even though it's the same thing. Sons who drank it, they've done experiments with business school students where it's a real thing. So, and I thought first that was idiotic, because you're letting the market tell you what to do, not the price value relationship. Then I thought it was brilliant,
behavioral wise.
Yeah, behavioral wise, you're trying to guide yourself away from doing stupid things. And then 0809 came, and he was forced to either sell his whole portfolio or just break his rules, because these rules don't work at extremes. So what do? You look at relative performance. It gets tricky, right? So I don't think there's a perfect solution, but I think there's a danger. I've fallen for that pattern a number of times where my thesis is, if I look over 5 years, I held something. My thesis is different. My value range is lower, but it's still super cheap. And I still own it, and I lost a bunch of money.
Yeah, but shouldn't you? So, of course, Gary, I always tell people that well, do you think it's better? I'm like, yeah, Gary's a better investor than me, and I think your process is better. However, I look at it from this standpoint. You're right. I own this stock. That's why I like what that guy. Hey, sell it all off. The right thing to do is I should have sold all Carnival and said, Paul, reevaluate it, because even though I understand what that theory is, but if you're really believing your process, aren't you just believing your process at that point, saying, well, I'm valuing this thing. And yes, and I do think that the debt level, and it's like saying, hey, I'm valuing this company based on 10% margin, but it's selling for 70% discount. Well, they only got 8% margin. Does that mean I'm wrong? No, it just means, hey, it's not worth what I thought it was worth, but instead of a 70% discount, now it's a 40%. Is that still a good enough discount? And I understand what you're saying. You're saying, well, Paul, then we have all these things. I get that, but that's why I like the bigger companies, because then I also maybe erroneously sit there and say, okay, well, what would have to happen for Carnival to really go away?
Yeah.
And I do feel like that's where I like the bigger large cap companies saying, well, what would have to happen, like Facebook, Meta, what would have to happen for a company with this little debt to really go away? With 3.5 billion people using their products every single day, what would have to happen for that company to go away? And of course, maybe I'm trying to justify my own behavior, but go ahead.
I will say, we were talking in the car about Carnival. it does give comfort to have those larger caps and have similar companies that are the same. Because I said to Paul, I said, the good news is for this, Carnival, Norwegian, Royal Caribbean, all in a very similar situation.
Yep.
In a very similar boat, you might say.
No pun intended.
No pun intended.
So if one goes down, do they all go? Is that possible?
Yeah,
of course it's possible.
I used to own Carnival. I was listening to Disney's call recently, and they were saying how their cruising business is big. And I was thinking, like, should I look back and come back to Carnival? And it's tough because, right, it's like very much of a business with high fixed costs and high financial leverage, and you need to have the ships need to sail full in a healthy demand, like delevering. Whether you're mothballing a certain number of ships and waiting for demand to come back, or even worse yet, if you have to send a ship that's 70% full, it just kills the economics.
And 70% full at a 50% discounted ticket price.
Right,
I mean,
or
you're
something
getting
like
killed.
that.
Yeah.
And I don't know. I mean, there was another smaller one, which I know you don't do, Lindblad. Which if you ever National Geographic cruises, like if you ever want to do a specialty, they have a brand. They have it's a licensing, kind of like it's National Geographic licenses the right for them to use the name, but they'll literally be a nature person, a photographer. Like it's a much smaller ship. It's maybe 100 people, not 3,000 people, and they go to where the bigger ships can't go. So it was a SPAC that went public and a few years ago, and I've been following it because that's more likely to come back first, right? Like people probably feel safer, on 100, and also the demand is less elastic because the rich people, it's like $1,000 a night average price versus like 150 or whatever it is for Carnival. I forget, something between 100 and 200. It used to be anyway. So, but anyway, it's
not your honeymoon anymore, Gary.
Nah, I know. Yeah. I don't do. My wife does not do boats, so I only get land-based vacations. And she's not listening, so I can say
we will send her an email.
Yeah, I'll send her an email
For the clip.
Maybe when one of my kids gets old, when I'm big into snorkeling, so when one of my kids finally gets excited about that, we can go on some cool Galapagos cruise and do bird watching and snorkeling.
We'll come with you.
Yeah, there you go.